All right, good morning, everyone. It is 8:22 in the morning of January 7th, 2021, and this is my pre-market strategy session. So the first thing that we have up here is ABSI. ABSI has just partnered with, Merck on, it agreed to enter a research collaboration with Merck using its artificial intelligence-powered integrated drug creation platform. Under the collaboration, ABSI will use its bionic protein amino acid technology to produce enzymes suited to Merck's biomanufacturing applications, receiving an upfront and certain other milestone payments. Merck will also have the option to nominate up to 3 targets and enter into a drug discovery collaboration agreement that will see ABSI receive up to $610 million in upfront fees and milestone payments for all 3 targets, as well as research funding and tiered royalties on sales. ABSI shares climbed 46% in pre-market trading, while Merck gained 0.2%. Yeah, that's good. $610 million for a company. Let's see. If we call that revenue. I'd say that ABSI, if it gets 610 million, Merck has the right to continue that, what have you. There's no obligation to that 610 million, but things are definitely looking good for ABSI here. What happens with the stock today? Well, I'm not really sure. I don't know a lot about these types of collaborations, other than in most cases, the small cap benefits from a collaboration with a large cap. So ABSI here, you can see it IPO'd back here in July of 2021. I went to a high of a little over 30, almost $32 there, and has been basically, trending downwards since. So this is no doubt a shot in the arm here for ABSI as far as revenues go. And what they can do with that as far as turning revenues into earnings and cash flows and so on and so on. Well, we'll see. This is just a trade, though. All that other stuff is for investment. So all we're paying attention to here is price action. So I'm going to put a Fibonacci on this. Now, it does have a pretty high outstanding. Shares outstanding are 92 million. The float is 60 million. So this isn't really a small cap biotech in the sense of what I typically trade on a daily basis, which would have, a really low float of like 10 million or less shares. So, we'll just kind of, I'm going to put this one on watch. It ought to give a trade, and exactly where that trade setup is, well, who knows? It could be, a dip below the open. It could open, dip below, and then run back above the open for an entry. Could go past the 75 and come back above for an entry, and then could find a bounce between 61.8 and 50. Exactly how it plays out today, well, I don't know. I would think that an entry averaging in between 61.8 and 50 is probably a pretty good place to look for a trade. But who knows? You just got to play it by ear. Control your risk. Don't risk a lot. I'll probably trade only 1,000 shares on this, and it'll be a quick scalp. It's possible that if it starts going up past its pre-market high of $10.59 here, then it's possible this thing really could run today. Wall Street, though, and the brokerages or whatever, the clearinghouses, I'm not sure, have all seemed to have ganged up on momentum trading these days. So, I wouldn't expect a heck of a lot of a run today. Over $10, okay. It's at 9.58 right now. So, 2 years ago, I would have, said, momentum trade, trade 10,000 shares at a time, so on and so on. Not this go around, not now. It doesn't work that way anymore. All right. So yeah, I will use the levels on these, and I doubt I would use a momentum trade. It's possible, but I doubt it. I'll probably use the levels. Okay, HGSH. This is total crap. I put it up here because it just seemed important to cover it. I'm not going to trade this. I wouldn't touch it with a 10-foot pole. The headline is China HGS real estate swings to Q2 profit amid nearly tenfold increase in revenue over 2020 levels. Well, now, isn't that just incredible? How much can you trust? I'll tell you what, I'll trust a communist as far as I can throw him. Okay, so communist China has real estate issues, and this company in this headline, it might, it might trade really well today. I seriously doubt it. I think this company in this headline is as bald-faced a lie as I did not have sexual relations with that woman. It's as bald-faced lie as there are weapons of mass destruction in Iraq. Iraq is working toward building a nuclear bomb. Just as big of a lie. So to hell with Chinese real estate and any kind of headline pumping up some kind of Chinese revenue, tenfold revenue. I don't know what in the hell is going on with Wall Street being the self-regulating industry that it is. However, they are allowing Chinese, look at it, it's starting to go up now that I'm talking about it. They allow Chinese companies to list in the United States, and they do not have to abide by the generally accepted accounting principles, nor, and I've forgotten what it is that Europe follows. Europe actually has more stringent accounting principles, and I've forgotten what they're called. However, every other nation in the world, South Africa, Brazil, Russia, what are some other some Middle Eastern countries? Saudi Arabia has some stuff that's listed in the U.S. exchanges. Every other country on the face of the earth has to abide by either the European or American accounting principles in order to be able to list and update on the American exchanges, except for China. And why in the hell is that true? It doesn't make a damn bit of sense, and if anything, it's setting up the United States to get ripped off incredibly by all these fake Chinese accounting practices and financials. The Chinese will lie and lie again and lie some more, and HGSH is a big damned lie. That headline is crap. Chinese real estate is in the worst shape it could possibly be in, and this headline is total BS. It might trade, it might still trade, but don't think you're going to be in it for a long-term position or anything by any means. All right, that's my rant for the morning. SGLY. SGLY is previously what was SINO. This is a Bitcoin miner. This is interesting. I just ranted and raved about Chinese companies. However, this is an American company that's been bought by the Chinese and is still run here in the United States and is still accountable to our accounting principles. So interesting here. It's not an IPO. This is just being renamed. I have, I'm just keeping an eye on it. Something interesting going on here. Okay. Then gold. So now gold actually is more, let's go over to rates here. So the risk range on the rates here, I have it 1.73 as the high end of the rate risk range, and 1.4 is the low end. And it's according to the hedge fund consultancy company that I use, the inflation, let's see, the increase in inflation is over at the peak in inflation rates as far as accelerating. is over. It's done. We might still get a high reading. Actually, you know what? There's a non-farm payroll that came out today too. I'll look at. It came out probably just right about now at 8:30, right? Yeah, it came out at 8:30. We'll look up that headline here in a minute. And so, yeah, the inflation peak is past. It's done. It's over. So all of the sort of rate-sensitive stuff, it's time to take a look at. And so that's basically why I've got gold up here. It's at the bottom. You can see rates are at the top end of their risk range, and gold is at the bottom of its risk range here. The bottom of the risk range is 1790. Actually, gold's dipping down a little bit below the bottom of the risk range right here. Good place to buy. And if you have anything that's rate sensitive, like for example CMA, Comerica is definitely very rate sensitive. It's time to, in fact, pre-bell here. It's starting to pull back a bit. So it's time to jump into and out of the rate sensitive plays, which basically means, although Comerica is rate sensitive, it's bullish as rates are going up, whereas gold is bullish when rates are going down. So now it's time to start averaging into gold and averaging out of things that benefit from high rates, like banks and insurance and major finance. So. That's that. Next up, I wanted to recap a couple of things from yesterday here. So FRLN, I warned against looking at this yesterday, and it didn't even give a trade here. Look at this. It just opened up and went red and just slumped for the rest of the day. There was absolutely no trade in there at all whatsoever on FRLN, junk. WBA, now this is interesting. WBA here yesterday had this opening range and then really couldn't hold on to its gains from its previous day's earnings. And it really did put in one of these candles over here from the 1st of July 2021. Here it had an 18% surprise in earnings and a 1% upside surprise in revenues. And you can see back here on this day, it opened at, we'll call it $52 and then closed at $48. So, a $4 loss on, a good earnings call. But then back here on, the 14th of October, a 13% beat on earnings and a 3.7% beat on revenues. And it opened at 47 and closed at 50.7. So almost a $4 gain. Yesterday, on earnings here, it opened at $54 and closed at 52.5. So not really the type of day that you kind of call that I would really look for after a good earnings report. But then you can also kind of see here prior to this earnings report, it already kind of priced in the best case scenario, and there's a 14.4% run in the 2 weeks prior to the earnings report. So, I didn't end up playing. I didn't play FRLN by any means, and I didn't see any entries on WBA yesterday either. So, just I left it alone. I actually wound up playing SPY options yesterday, and then something else popped up. Oh, EAR. And actually, I left EAR alone as well. I didn't play EAR either. It looked as though it had pretty much done its thing pre-market. And something else that's been going on here, EAR is a small cap momentum. It has 40 million shares outstanding. It traded 137 million shares yesterday, and the total range here, let's see, from top to bottom, absolute bottom to absolute top here was $2. A $2 range on 137 million shares traded on a stock that has an outstanding of 40 million, call it 40 million shares. Yeah, so small cap momentum, it's just not working anymore. I'll come back to it probably somewhere in the tune of about, 2 months or so, from September to January. I'll keep an eye on it for about the next 4 months or so and see if it can pull back down to its previous to the gap basically, and see if I can pick up some shares there as an investment. The headline is good, and it'll also give another earnings statement in between to see exactly how this recent headline has affected its earnings, revenues and earnings. So then next up is MYNZ. Is this one that? Yeah, MYNZ, another one that I'm just kind of keeping an eye on. You know, this is a recent IPO. Had a great headline, if I remember correctly. Let's see, what was the headline here? For oh no, okay, this one's the one that acquires exclusive rights to these biomarkers and so on and so on. Yeah, that really depends on whether they can turn those exclusive rights into revenues and earnings. So that's probably one that I'll probably leave alone for quite some time. IMMX is kind of flailing around here. I had it on watch yesterday for a break over 868. You can see basically it opened and just trailed down. So it didn't trigger the alarm, and I didn't pay attention to it at all yesterday. This one is interesting. Okay, this is the pediatric disease designation by the FDA. And then there's going to be a fast track and so on. There'll be more headlines to IMMX. I'm not interested in it until it gets back down into the 3.5 range. Okay, seeing a pretty big spike right now in the VIX, the non-farm payrolls. I'm guessing that means the non-farm payrolls are actually really strong. So that means that Wall Street, if what I'm guessing here, just by the looks of it, non-farm payrolls are probably really strong, which means that the Fed is more likely to tighten, which means that easy money on Wall Street is drying up, liquidity is drying up, and the market is tanking. Now let's see. I guess Yahoo Finance will probably have what I'm looking for right there on the headline. If not, it would be MSNBC. Whoa, kind of large there. Oh, whatever. Yeah, here it is. December jobs report. U.S. employers added 200,000 jobs, 199,000. Unemployment rate fell to 3.9%. A huge miss on expectations of 450,000 number of jobs added. But you see this 3.9% unemployment, that's full employment. Anything below, actually, if it starts getting too low, that's actually bad because that means people are stuck in their jobs. But 3.9% is considered, or 4% is considered full employment. By the Fed's metrics, that means the economy is cooking, and it's time to rein in inflation. Inflation is a danger. This is a green light for raising interest rates, and that's what Wall Street is freaking out about. This isn't the jobs report, 200,000 jobs added. That's not what is spooking Wall Street. What's spooking Wall Street is that the Fed's going to raise interest rates and easy money is going to be gone, which means, liquidity is what the market runs on. Plain old, simple cash as a lubricant is what makes the world's markets, financial markets, turn. And when there's more lubricant, it runs faster. When lubricant starts to dry up, things start to come to screeching halts, and very quickly. This is a strong unemployment rate, 3.9%. A miss. They're expecting 450,000. My hairy caboose, my hairy crack, 450,000. I don't know who's coming up with 450. There's no, in the past 12 or 24 months, there is no precedent, none, zero precedent for a 450,000 increase in employment anywhere. I mean, 200,000, 250,000, okay, yeah. But 450,000, somebody is smoking crack, and they're using this as an excuse. You watch, the narrative is going to be, oh, the jobs numbers missed, the economy's tanking. No, the Fed is getting ready to tighten, liquidity is getting ready to dry up, and what's that saying that Buffett says? When the tide goes out, you see who's swimming naked. So the tide's about to go out, and we're about to see a whole bunch of naked bodies out there. All right, everybody. That's going to be. I guess we'll look at a couple things here. VIX. Yeah. So the VIX here is popping up. Top end of the VIX on the risk range here, I have it 20.28. So we are right there this morning. I imagine today might be the day to start. I would say today's probably the day to start putting in some rate sensitive trades. Get those rate sensitive trades going, and that's pretty much. I don't think. Otherwise, just pay attention to the risk ranges here. Let's check out the risk range on the SPX here. Let's see where we are. This actually, we won't know this until it opens. Bottom of the risk range here is 46.85 on the SPX. So buyers ought to come in right around in here. More importantly, I think the better place to look for a buy, though, is going to be on gold. It's probably going to be the better place to go for a trade today. All right. Yeah, it's at the bottom of the range. So, okay, everybody. Good luck out there. Keep your wrist tight. Click like, share, subscribe, leave a comment, tap the bell, and I will see you at the recap. I am out.